Quant. Uh, Today we have a diverse panel group in terms of representation from across asset classes, be it real estate. We'll also cover a bit of Bollywood, and then you also have to some extent impact investing that we'll cover up. And I'm 100% sure in the sense we'll keep it more engaging. I know it's difficult to have it's second last session for the evening. You haven't had a long day. So I think I'll directly start an interesting topic to see because during the day you would have had discussions on alternative investments. This session is to how to generate income from all these alternative investments. So we have with us across. So my first question to Gaurav in terms of understanding client behavior and how has the client behavior changed. We have seen there a lot of buzz around alternative investments across India, especially on AIFs. So across AIFs, how has the client behavior changed in terms of getting diverse views and diverse strategies across real estate equities and also if you can just throw a light in terms of any particular change you are looking at clients.
Yeah, so what I'd say is, look, historically we have, the Indian investor has understood returns, not necessarily risk associated with that. And I think there was some amount of awareness in the '08 crisis, and even subsequently next 5 years have not been the most benign macro. So I think one thing I realize is, you've seen is that the investor now is more, understands risk better as well. Compared to traditional alternatives that he had, being fixed income and debt, I think alternatives as a space has opened the investor up to a wide variety of other income streams. And he or she has the ability to choose that income stream depending on what his risk appetite is. Could be illiquid 10-year investments or liquid shorter dated investments, and to calibrate the risk he's taking with the returns they're getting. So I think that is one change which I find is figuring out your risk appetite and tailoring your returns on the basis of that. And the fact that there are numerous opportunities available in the traditional bond or fixed income market earlier and an equity market, it just gives him a bigger bouquet to choose from.
So would you agree the client today understands better on the risk versus the opportunity ahead for him, or there is still, it's an initial stage where there's a lot of work to be done on the AIF especially?
No, I think, look, there's a lot of work to be done. It's still very early days, nascent stages. The AIF category is still growing. But to put this in context, even globally, alternatives have been growing at 12-13%. Traditional asset classes have been growing at 5-6%. So even though alternatives have a market share of low teens, but they're a fast-growing asset class. Now in India, that number is probably sub 1 or 2%, the market share, and I have no doubt that it'll inch up over time. But it's very early days, and a lot more investor education would be required for that. But the growth trajectory and the direction to me is it's been a good start, which probably will follow what the global trajectory is taking it.
We have had new investment ideas coming up, and I think it's getting more and more for clients to understand that investment idea, be it from commodity side or asset side or real estate. Suresh, what has been because you have been dealing with offshore clients as well as Indian clients, so do you think
most of our clients
the criteria remains the same for both set of clients, or
most of our clients are based in the UK, so the NRIs from India.
Yes.
But as far as real estate goes, their mindset has changed, mostly because of the media, because TV's become people's gods now, right? So there's been a lot of auctions where the realm of property veteran, the investors, professional investors and traders. But now, because of TV programs, focus on auctions, telling people how to do it, there's been a lot of end users now going into auctions. So the mindset has changed in that people think that they can also purchase and do development. So now auctions have become a place to even sell. You can get more money at an auction than a normal agent.
Abhijit, you have a very diverse portfolio in terms of investment ideas on alternatives, from renewable energy to healthcare to education. how open have been the clients on this space, and how difficult is for you to convince clients for investment ideas?
Good afternoon, everybody. Very interesting question, I think. One side, if you look at, you heard a lot about alternatives. I don't know whether I can categorize the impact investing space under the, pure play opportunity we are talking today. But if you look at, this is a sector which is growing at a very fast pace. If you look globally, 46 billion funds are put in impact investing funds. So it's not a small amount, $46 billion. And if you look at India, I mean, most of the funds are focusing on India because India is the largest market today. After Mr. Prahlad, coined his book on the term that bottom at the, economic pyramid, fortune at the bottom of the pyramid. So I think more and more investors are looking at this space, whether it is microfinance, whether it is microinsurance, micropension, affordable housing, affordable healthcare, renewable energy, affordable drinking water. So all these things which are affordable or which can reach the masses has become a very interesting investment opportunity. And day in and day out, we are finding a lot of interest from different set of investors, whether it is the family offices, whether it is people like Bill Gates, who has put in money recently. You would have heard in the newspaper that one of our sister concerns, Unitus Fund, has got funds from Bill. Even in India, we have been lucky to have people like Hemendra Kothari, Ranjan Pai, Mohandas Pai, putting in money for the impact space. So which effectively means that yes, return is critical, and yes, impact businesses are giving return, but there's a double bottom line approach that you are at the same time being conscious to the society, trying to make a difference. Whether the returns are right or how much it is, whether it is appropriate in terms of compared vis-a-vis what you get in stock market. I would say in many cases it is much more than that. And we have seen in some of the exits we facilitated that returns can go as high to 55-60%, and that to between 3 to 5 years period, which I would think is a very good return. But obviously it's early days for this segment in India especially. And I think in the next 3 to 5 years we'll be able to tell with much more confidence or much more data that how it is shaping up. But yes, this is a new investment opportunity. Huge amount of focus we are finding even from the mainline P and VC whom we work. They are looking at this impact as a big space and putting in millions of dollars.
Mr. Handa, your views on how do you find interaction with clients? Are they changing? Are they expecting more? Risk versus return favors in respect to a client? Or?
Well, when you talk about Bollywood, people have some of the myths right up in their mind. They love the product, they love the industry, but their understanding of the industry is very poor. And industry has evolved over a period of time, and it has matured. And today, it's not that industry where you put money and you lose your money. It's people who put money in one film, probably may be successful, probably may lose everything. But when you take a very consolidated approach, portfolio approach, the product is quite different from what one can think of. So Bollywood is something that everybody is attracted to, everybody loves it, everybody is interested in it. And I think more important is how the distributors actually go and bring about that type of awareness amongst the investors. The investors have certain myths. We need to really break those myths, explain to them very carefully. And we're finding a lot of interest now coming up, and people are saying, look, this industry is growing at 13%. It has no volatility. It's been growing at 13 to 14%. It's now going to be around 18 to 19,000 crore industry. There's a lot of money to be made. Let's tell us where the money is, and that's why we are here to tell you where the money is all about.
Gaurav, back to you. You manage most of the funds on the long short, on the equity side, and so what kind of returns do a client expect, especially looking at the risk he takes, and how different it is for him to have, from his perspective, from open-ended investments to something that is closed-ended, something that is more on long short of the market?
Look, so when the fund we run is an open-ended fund, it's monthly liquidity, so it's not a close-ended, so it's quite a liquid product. The the return expectation really is a function of how much volatility you're looking to wither on your portfolio. It could be anywhere between equity plus with slightly lower volatility, or something close to a fixed income fund with extremely low volatility. So again, there's a wide specter of where you can expect, investors expect their returns. Again, it becomes a case of where they want a fixed income plus product or an equity minus kind of a product. So that's how the broad risk return perspective from an equity long short is.
Abhijit, how easy for you it is to explain the return potential especially on an impact investing? Probably for an impact investing kind of portfolio, one way definitely should see a return, or should he see a sector exposure, should he see the sector demand what he is getting, or the client has to have an understanding on what he is investing in and what kind of impact it has.
Yeah, I think for any investor, whether it is a social investor or impact investor, return is critical. The question is the degree of return, or the absolute percentage can vary, but they are using money, third-party money, to make investments. So they are responsible to their LPs, so they have to return. Now, one side, India is a huge market, so growth of any of these businesses is large. So many of the investors look at the growth potential and see return, a very high return. But if I go by the data, I mean, recently in May, I think 2014, GIN, Global Impact Investing Network, along with JP Morgan, has published a survey of 125 impact funds, and there they looked at the return expectation and how much they have got return, the investors have got return. I was surprised to see that more than 50% wanted much more than the market return that's defined. And then out of which almost, I think 27% had already made returns much higher than what is the market return expectation, which means that the return, one is expectation is there, which is above market. Two is they're already making those returns. So that means they're looking at investing in scalable businesses. And India as a country is growing at a certain pace, and then the population, the have-nots basically, where these all are targeted at. If you look at where India has a banking penetration of only 50-odd% or 54 or 55%, most of the people don't have banking accounts. Then they don't have loan. I mean, 3% cannot access loans. So of the population. So this is a market which needs, even if you look at the healthcare side, 25% of the population falls below poverty line every year because of the healthcare expenses. Why? Because they come to the cities, spend tons of money on this, bigger hospitals. So if there is something which is affordable, I mean, investors know that this can scale. There's a lot of demand there. The price points are reduced. Even in case of drinking water today, I mean, pure, clean, potable drinking water is becoming a huge demand in the market. What is the price? The Bisleri was at what price when we started, and now look at any packaged water, what is the price? So I think there's a huge demand, and then investors are getting return. See, in general, there are investors who are happy with say, I would say 15% to 20% IRR, but most of the large size impact investors who are even targeting like the retail clients, they are looking at anything between 20 or 25 or even more.
Mr. Handa, for you, I have a very specific question. Now, you invest into a Bollywood movie. And we come to know Bollywood movie has made tremendous money. It's a blockbuster. 400, 500 crores is normal these days.
Sure, Chennai Express, let's say.
Safe to assume I have made a 50% return or 100% return on my portfolio?
Well, you see, we did this assessment for 2013, and we took about 50 films, like 50 stocks we did, and the average return was about 35% plus. Now it's again where you want to play the game also becomes critical. There are big films, budget films like Chennai Express, which may cost you anywhere between 150 to 200 crores. But there could be a film like Queens, which may be just about 10 to 15 crores, and will give you a return of almost about 70, 80 crores. Now you are talking about exponential return there. Now one has to understand today the returns are just not the theatrical returns. The return from theater is just about 40 to 50%. How do you exploit a film becomes very, very critical. And that exploitation is all about satellite rights, all about distribution globally. I was just telling to somebody, if the China opens a market, and it's likely to open in very near course, the China market will be 3 times the Bollywood market in India. Just the China market. A movie like Lunchbox in Germany did $3 million. And the cost of the movie was less than $1 million. So that's the type of opportunity one has today in the industry, provided your portfolio approach you're taking. You're not banking on one movie to be made over a period of 3 or 4 years. You're taking a proper portfolio approach. You're exploiting the satellite rights. You're exploiting the distribution right. You're building a marketing capability. And then there's the opportunity of good returns coming.
Coming to Suresh, you have a portfolio of where you take on distress assets,
Yes.
majority.
Yes.
So what would the return potential for, especially when you take a distress, which everyone would assume will come at a significant discount?
Yes.
So how does the portfolio composition, and what is the risk profile, and what is the return one should expect, especially investing into a portfolio like that?
We don't do portfolios. We act for individual clients, so we set up syndicates.
Okay.
Right? But yeah, when we get distressed, there's 2 ways in which we treat it. Either we put 10%, give a real life example, we bought a block of flats in Maidavale, St. John's Wood, so a lot of Indians also like this patch. So we bought it in auction, and on an auction, but when you talk about distressed stock, people think it must be backhanders or exclusive asset, but this property was actually on the auction, so anybody could go in and put their hand up. So we picked it up for 1.1 million. So we put 110,000 pounds at a 10% to exchange, and then 3 days later we sold it for 1.3. So from 110 we made 200 in 3 days. So the IRR goes through the roof. There was one sort of inside knowledge you could say that we had, in that in the auction writings it said the tenancies were unknown. Now when it's unknown, people get very nervous, and like when you look at behavioral science, when people get nervous, they get very nervous. But when they get confident, they only get a little bit confident. So they assume the worst. They assume that all 5 properties have life tenancy, meaning you can't kick them out, and they pay a very low rent. But we got information from the agent opposite that they're all normal tenancies. So on that basis, we've done the deal. Yeah. So yeah, on that situation, we put in 110, we got 200. That was an exceptional deal.
Okay. Gaurav, back to you on, especially on the long-short kind of portfolio. As you mentioned, the portfolio will do well the more volatility markets have. So in case where everyone is so bullish on market, we are looking at everyone defines the index level to a new high every day. So do you think still the long-short kind of portfolio will make sense for a client, or he's very good on an open-ended, long-only portfolio?
See, volatility is one aspect, which is an ingredient which allows for a good long-short environment. The other and the bigger element is dispersion. And to put it in very simple terms, it's that sector and stocks move in different directions in any market condition. So we looked at the last 10 years when markets have been down 30%, up 30%, and sectors, the best and worst performing sector has a spread of as high as 50%. Even for example, 2014, which has been a great year, we have the telecom sector, which is 0%, right? Financials, obviously 50% plus. And when you drill down to even a specific stock level, you find this dispersion is even higher. So even within telecom, for example, RCOM is down 10%. Now, when extending it to other sectors like materials, for example, GSPL is down 30-odd%, some other stocks are up 20-25-odd%. So when you couple the dispersion along with the volatility, that for us is what creates the perfect ingredient for this long-short investing. And why, while we say that the index is going to be higher through cycle, it's a constructive view on the market, it's rarely in a straight line. You will get that patches of volatility for 3-4 months where you have those market jitters, and that's when you'll see the advantages of a risk-adjusted long-short portfolio.
Okay. This brings me to the next topic on, we talked about clients who will be looking at investment ideas. This question is for all panel members on how do you see the wealth platforms gearing up for all this alternative investment products, and do you think the platforms are still geared up? Because eventually these are the platforms which then talk to clients and then get the clients on board. Do you think there are enough platforms that are geared up, or there's a lot more work to be done on this?
I think, it's a normal human tendency is to have the herd mentality. What sells, you sell. And you offer the client only what is in the market that sells and what client wants it. And it's easier selling also. You don't do any concept selling. You just go with the real estate project, or you go with an infrastructure project and then sell it to the client. But in the end, if you want to create a value proposition for yourself, I think you need to be different. You need to evaluate different products. So maybe a social product which gives a 20-25% return. A client may be inclined to look at it and say, look, I want to also contribute to the social sector. That could be a great product that you can offer. Or he is very attached to emotionally to film industry and seeing 200 crores, 400 crores movies are making and saying, hey, my God, there's something that I want to look at it, and how do I really start appreciating the film industry now? You would get a whole lot of people who would say that you have confidence, then I'll take the product. But you need to get educated yourself first. You need to be synced into the product first. Once you are there, either in the social sector, I know the social sector because I've worked in social sector. If you are there, you understand these two sectors, then you are able to sell to the client better. So my earnest request to all the distributors is, don't summarily, dismiss a product. Get into it, understand it, and you take a risk, and your client will take the risk.
Abhijit, your views on it?
Yeah, I think similar to what he said, where some examples also I'll quote. I think even when I remember when I met Mr. Kothari, I'll quote this actually. The first thing was it's very difficult to convince. He says, you talk me about tiger conservation, I'm happy, but don't talk me of investment in social sector. I mean, you're talking of my money going and making investment in a company and the return comes. I think it's a long shot.
Yeah.
I think it's not something I would be keen on. Rather, I would be happy to donate for a hospital or a tiger conservation, which is in the core of my heart. So it's difficult. He was right, and finally he invested, which is great. That means at some point he felt that this sector which is going to grow, and and he gave his contribution was token, but then it really helped the sector. So I think if you look at, I'll quote another public report only where it talks about one fund, which started in 2007, actively investing, and today is 2014. In 7 years, they have raised 3 levels of funding, 3 rounds of funding. They have made 48 investments, smaller investments. They made 11 full exits, 4 partial exits. So, and this is a social fund. So today, if I quote our own sister concern, which is Unitus Seed Fund, just 2 years into operation, where Mohandas Pai, Ranjan Pai, Hemant Bhai, and all invested. I mean, already we are in 2 years made 14 investments. I know some of them will not be as great, but some of them making amazing progress. So, you're right when you said that don't dismiss an idea. I mean, for us initially when we started in 2008, immediately the crisis happened, global financial crisis. We went through hell, convincing investors, new asset class. How difficult it would have been, you could understand. But today, after 6.5 years, we have done more than $1 billion of raise. We are today doing around 12 to 14 equity deals every year, if not more. This year, I think we will close around 16 or 17 equity deals, all for the social business sector, all for impact investing. So that means there is asset class which is interesting, and it's not about just equity. I would come on the product side as well. Apart from equity, we are doing debt, and debt is a very interesting product where you can exit early. Equity may take a bit longer. In the debt, you can do 3 years, 4 years, even 5 years, and the returns could be as interesting for early stage, promoter or a entrepreneur. He doesn't want to dilute, and he doesn't get a bank loan. Today, if you look at Indian banks, nobody lends early stage entrepreneur, and he may not have enough collateral as well. At that stage, if you can come in with a debt, it could be as high as 18 to 20%. They're ready to pay that. I think you can make a very good return out of debt as well. And if you do a sub, obviously you can earn much better. So I think overall, new asset class, focus from a diversification perspective, from a return perspective, and also the third or last element is on the impact side. You are making a positive impact on the country and its economy.
I think the other topic I would like to discuss is on the regulatory and the environment supporting AI apps. So do you think there is enough regulatory support that happens, or with every new idea, it becomes more and more challenging to go to a regulator, ask for an approval? So,
see, in India, we never look at anything holistically. The road construction guy will construct the road, and the drainage guy will come later on, and so on and so forth. You don't take a holistic view of anything. If the alternate fund has come, and it has to take a holistic view, both in terms of regulation, both in terms of tax, and both in terms of market risk and appetite. There's no holistic view at all. The tax guys are on their own way, the regulations are happening in their own way, and the investors do not know what exactly is happening. So if you take a rounded view of taking all these three stakeholders together, you would have a fantastic product that is coming out. But that's not happening. Therefore, I think both in terms of ticket size, if you look at it, in terms of being a closed item or an open item, or the tax treatment to be given to this fund, or an opportunity to get listing these funds, or to buy out of these funds, these are things that I think the regulators have to think very, very closely to make this market a very robust market. My humble request to Centrum and all those who are organizing here, you need to prepare a white paper out of all these conferences. The only value of these conferences are not people sitting here who would really benefit from it, but is to go back to these guys, the regulators, the stakeholders, and give them and tell them, look, this is what we feel you should be doing. And this is what we feel that you need to implement to make this industry more robust. So if you can put it up, these discussions you had from the morning, and then get that white paper and have a follow-up discussions, and we will be very happy to pitch with you along and go and chat with these regulators and tax guys. I think that makes this industry more strong.
I think very interesting point there, if I may add. In the morning itself, Mr. Barua from SEBI was saying that we have made pass-through, but effectively somebody has to pay the tax. I mean, at the end of it, you have to pay the tax. So in the AIF also, that has been made, but ultimately, I think the entire benefit has not been given. So rightly said, if you look at the UK, they have come up with any impact investing, there's a 30% concession there. So even in the US, the government is allocating separate funds. So I would say in India, there's something which has happened. Like if you know in microfinance, especially government has set up a 300 crore fund, which is sort of good, I would say, support for especially the smaller entities which can't get funding from private equity and all. Similarly, if they can do it for other sectors, whether it is healthcare, whether it is education, whether it is affordable housing and all. Some work has been done on affordable housing, which will come up soon. But overall, I think this type of SOPs, even in the US, I think government allocation is there for 197 plus 300, total $497 million of budget for skills, for education and all, which is the government support, mandatorily going for this as an equity investment at a long tenure. So some of these supports could ultimately help in setting up, investor sentiment to invest in this sector. So it's about not only the SOPs, but also the facilitating environment wherein it says that, okay, this fund has performed well from the government. So, private individuals can also put in money to get good return.
And the entire awareness of alternate fund is not being very widely spread out. People are not knowledgeable about what is this alternate fund all about, what are these regulations, and what does it mean. I think that awareness also is the duty of so many people sitting around this table to bring about. And the SEBI also has to do a lot to bring about this awareness.
Suresh, my question to you is on specific to London market. We have seen London going through, on real estate prices, so what it was, then to a peak, and then going through another phase of consolidation. So where do you think the prices are headed, and what are the best pockets to look at investment in this market?
I think you're going to have a dampening for the next couple of years for various reasons. One is interest rates. People are very nervous. Interest rates are going to jump up and affect property heavily. The other thing they're nervous about is the election. And this new mansion tax, which will effectively tax properties on a yearly basis. So there's a few things that they're worried about. But I think this is real estate you're talking about. Real estate doesn't crash. Real estate goes down by 10 to 15%. Right? But the word they use is wrong. Stock markets crash, companies can crash, but a property doesn't crash. So therefore, I think you never make money by following the herd. Otherwise, the herd would be rich. You make money by going against the herd. And this is property, so property is a very forgiving business. There's a good saying, even if you buy a bad property, it's like having a bad haircut. If you wait long enough, it'll grow back, right? So even if you're stupid about it, you probably do okay, given time. So I think whilst the sentiment is down, I think it's a great time to enter the property market. And in regards to location, it goes back to the basics. I always believe in going to the basics. Everything is governed by demand and supply. So you go for a place where the demand comes from all over the world. And that's London, right? There was one report where 25% of all the business done in Mayfair was done by Indians from India. That just gives you, that's indicative of how the variety of the demand. So yeah, if the demand comes from over 60 countries and the supply is very constrained, it's a good place to invest. Simple as that.
And I think all panel members agree it's a upbeat, they have given an upbeat tone on all alternative strategies what they have, and there's enough return potential. I think now we'll open up for any Q&A for any panel members.
What would be the right framework to look at social enterprises? Cinema we can understand a little bit in case of cinema funds, but in case of social enterprises, what's the right framework to look at?
So when you say framework, are you referring to?
A evaluation of that, what is the business opportunity likely to be? Let's say, when we talk about real estate fund, we can say, okay, maybe in 6-7 years you get to 2x, 2.5x, given a certain basic economic condition happening. In case of social enterprises, what kind of return expectation and what are the filters one can use to evaluate whether it's a good fund or a bad fund?
Yeah, it depends on the fund managers with what proposition they are going to the investors. Okay. So as I was referring to, in the survey which is available in the public domain, it's called GII, and the Global Impact Investor Network, okay. And JP Morgan has done this study. Sure. When they have looked at global 125 funds, they surveyed all of these funds. And finally, there the return expectation can be, below market, which is around 15, 16%, to above market, which is 30, 35% or 40%. Even, if I look at individual return of the different the deals we have done in India, wherein we have the lowest we have done is exit of an investor at 17% IRR, and that too in I think 3 years period. The best we have done is around I think 54% IRR, and just in 4 years time. So it depends on the investors we are targeting. Sometimes when we go to really socially focused, completely social focused investor, and we want to run a sort of like a donor driven fund, then the return expectations are very low. But if we are going to the pension bodies in the US, the university endowments and all, there the returns are all 20% plus, and can be, the hurdle could be 20 or 25, depending on which investor they are targeting. So there is nothing fixed in that, depending on the GP what they want to really do out of this fund, and whom they are targeting as an investor is the critical question.
One more question on this. In case of this, are these more of regional businesses or are these pan-India businesses?
Yeah, so see, we have done deals which are local, and some of them are pan-India. Like if I look at microfinance, like if you look at Janalakshmi or Bandhans, we have done transactions there which are pan-India organizations. Sure. But we have done also for some of the Bangalore-based entities, or for that matter, one is a Odisha-based entity we have done, wherein we raised around 70 odd crores. That is a local player. So depends, there is no hard and fast, depends on what is the capital raise, whatever investor you are focusing. Some of them are like, one of the Odisha deal was of Fidelity invested, it's a big investor. And some of the deals we only do with very socially focused investors who are long-term, say they need 10 years of exit period.
Thank you.
So
There's one there.
There's one. There's one more question.
Hi, my question is for Kewal. When you talked about the cinema fund, one thing that we have always been noticing about a lot of cash intensive business this being, and which certainly would mean a lot of leakages which can come in. So A, wanted to know what is it a myth or a reality? And B is when you spoke about picking 50 odd companies when you did your analysis, coming to a 35% odd return expectation, what has been your criteria for filtering those 50 companies? Because at least in a capital market, we do understand large cap, mid cap being one of the criteria. So how did you select those 50 companies?
Fair enough. So let me answer the first one, is the cash portion in the film industry. Actually, it is today very negligible, almost zero. I said industry has matured and evolved. You look at, there are corporates today, both at the back end as well as at the front end. At the front end, you have PVRs and others where everything is digitized. The income stream is very, very clear. There's not like standalone single theaters where you have to just cut tickets and nobody was aware how much was collected and how much was given back. Today everything is digital. You know in the evening exactly how many tickets have gone, how many shows have been booked and whatnot. So you can watch on your screen to know which theater has done what collections. So that's why you have those collection figures coming every day. So on the back end, you have a fantastic control today through proper budgeting and audit. And everything is managed and monitored today. So the entire business today is absolutely clear, check. There could be better business than the real estate business, but still you have 30-40% cash. When film industry, you have hardly any cash. So that's a myth people carry with, it's a cash business. It's not. So that second thing that I want to talk to you is you talked about the success and the failures of film. We looked at different films, blockbusters, failures, and we looked at mid-size and also the large films. Now you can say, like a Chennai Express, I gave an example, it did about 300, 400 crore rupees. The movie got sold for 200 crores also. But if you look at Ashiki, which was a movie of 10 crores, made, let's say, 80 crores or 90 crores. Now, the myth is, again, these are all theatrical incomes. And I said, theatrical income today, where the cash portion really probably is a little bit still there in single theaters. Theatrical income is today only 40 to 50%. The balance is all exploitation, is all satellite rights, which is all check. And that's where the income generation tricks. So the industry has evolved, it's matured, it's far much better than the real estate industry and many other industries that deal in cash. And that's where I said the investors should have more confidence in investing in this industry. Going at 13%, going to be about 19,000 crore industry in future.
My question remained unanswered. I asked you, how did you arrive at selecting those 50?
I said it's a mix. It's a different films mix. And it's a different success and failure mix.
Okay.
Thank you. I would like to now request Mr. Sandeep Nayak to kindly come on to the dais along with Mr. Aditya Gadge to felicitate our panelists.